Hello, and welcome back to Financial Education. My name is always Zach Collins, and today I wanted to discuss the impending issue with index funds. You might think that the title of the video is clickbait, but I promise you it's not. Did you know that there are some glaring issues with index funds? Before we get into that, for those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and its firm was very heavy in sales. I've got no interest in sales. An advisor is not all sales, but my passion is to help people, not just sell various managed funds or insurance products. These days, I work in tax and compliance. Before I get into the issue at hand, let's take a step back and ask the question, what is an index fund? Think of an index fund like a basket of goods. It holds a bunch of different things. There's some honey, some bread, chocolate, milk, socks and jocks, shoes, whatever. There's a bunch of different things, except instead of being physical goods, the basket of goods represents different companies. Let's say one company farms the cows and makes the milk. Another imports cocoa beans and makes chocolate. Another is a manufacturer that specializes in clothing and makes socks. You guys get the point. An index fund is a basket of all the companies that make up that specific index. There are lots of different indexes. There's one that tracks the S&P 500, for example, which is representative of the US economy as a whole, and it's got about 500 companies in that index. There are indexes that track the S&P 200, which is Australia's largest 200 companies. There are indexes that track tech stocks, and there's indexes that track banking or financial services. There are a ton of different indexes and a ton of different ways that you can invest in index funds and get access to those companies and whatever specific basket of goods you want to invest in. Given that index funds hold a large range of companies, surely that must be a good thing. Why would it be bad to invest in index funds? So the issue with index funds is how they allocate the funds to each company and the amount of money that is directed to each company in that index. So most index funds use a market weight allocation. Let's say the total market cap of every, that's the total value of every company in the index. If a company's only asset is a pen, and that pen's worth $10, then the company's worth $10. Now, let's say the market cap of an index is $100. Company A is worth $10, company B is $5, and company C is $1. If I've got $100 to invest in the index, that is exactly how my money is going to be apportioned. $10 of my investment goes to company A, $5 to company B, and $1 to company C. I have no control over who gets what percentage. Let's say that next year, I want to put another $100 into this index, except over the course of the year, each company has had variable performance. Some have done well, some have not. I still don't have control over how much is allocated to each company. It's still done based on the market cap weighting. Let's say company A has underperformed compared to the index and it's now only worth $7. Company B has done well and it's worth $7 too. Company C is now $2. That is how my investment will be apportioned. If I invest another $100, $3 less will go to company A than last year, $2 more will go to company B, and $1 more goes to company C. I'm trying to keep it pretty simple at this point in time, but if you guys have got any more questions, please drop a comment below and I'll answer to the best of my abilities. This is pretty straightforward for now. We're using $100 as the value of the index. Obviously, the index is worth a lot more, and you're talking hundreds of billions, but the premise is exactly the same. At this point in time, the market is it's doing fine. But the issue becomes when there's too much money in the system and everyone is buying the exact same assets. Let's use the pen analogy as before. Let's say company A's only asset is a pen worth $10. If I buy all of company A's stock for $10, it means I bought it at fair value. I bought an asset that's worth $10 for $10. If I was instead able to get company A for $5, it means I was able to buy it under fair value. I was able to get a steal. I spent $5, but realistically, I could sell that pen and get $10 and double my cash instantly. This is the sort of strategy that people like Warren Buffett use. They buy companies that they believe are strong, important companies, but they get a bit of a discount with the purchase price and make a pretty guaranteed profit. If there were a lot of competition and you bought company A for $20, it means you bought over fair value, and if you were to sell that underlying pen, you'd be underwater. You've lost money. The company is worth $10, but you paid 20. So theoretically, you've lost 10. That is, unless the company can continue trading and find a second pen for $10. Once they've got two, you're basically at break even with your purchase price. Now, all companies can be represented in this way. There's a lot of different ways to calculate what the fair value of a company is. You can use future earnings, you can use profit, you can use book value, etc., etc. That's not what this is about. The issue with index investing is that it doesn't matter what the fair value of a company is. If you're investing in the index, you're buying everything that's made up of that index. It does not matter what the value is. Today, that's fine because the dollar amount being invested in index funds compared to active investors, be it active fund managers or large super funds or every other day investors, is smaller. The index fund market, however, is starting to grow and it is growing fast. There will come a point where index fund investors will significantly outweigh active investors. And what will happen is that it will cement the position of companies in an index. If investors are using the first example I made, they would always be putting $10 into company A, $5 into company B, and $1 into company C. Because there was so much money being poured into the index, there was no way for companies to grow faster than another company in that index because investors have already decided how much they will put into each company, and that will always stay fixed. It will mean that eventually, if I'm always putting $10 into company A and they don't produce more pens or grow faster than the money I'm putting into it, eventually the price will grow beyond fair value, and on every valuation method, it will be overvalued, and I'll be underwater if the company had to liquidate. At some point, let's say company C is a very high growth company. Its revenue and profit are growing massively year over year. However, because it's only getting $1 of new investment, it's never going to be able to grow as large as it should, and it will forever be undervalued. I'm not trying to fearmonger here, but this is a legitimate issue, and it's one that is yet to come to fruition. We're not looking at this happening in the short term. We'll probably be fine, I'd say, over the next 2 to 5 years. Longer term, however, we're talking 10, 20 years in the future. We could see some big issues and index investing as a strategy collapse. Hopefully, I've been able to better help you understand the potential issues that may arise around index funds in the future. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.